Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Moneeka Sawyer.
Hi, ladies. I am so excited because today we are going to do something a little bit different. So one of the things that I've been thinking is that as we've gone through the last 3 years of this podcast, every single time I get on I do a show, we record something new, right? There's a new idea or new strategy or a new opportunity, right? And I love that. It's very exciting to me. And I know many of you love that too. But what concerns me a little bit is that I feel like I might be confusing you. Instead of giving you an opportunity to go deep and to really learn strategies so that you can make a decision whether that strategy is right for you or not, instead, I just keep presenting new opportunities, which I think it's confusing for me hearing them. Like I think, oh, that's a really good idea. Oh, that's a really good idea. And I know that if I wasn't already sort of well implanted into some strategies that I'm already using, it could be confusing for me. So I've decided, in order to support you ladies to actually start taking action and grow your portfolio and become super wealthy and blissful, that I'm going to start doing some different series. And each series is going to be focused on a strategy that I've heard a lot about from you. So you've asked many questions. You want more information. I've brought on several guests onto the show already about that topic because of your interest in it. So what I'm going to do is create some of these series that will be kind of like a deep dive into that particular topic. Sometimes it's hard to go back and re-listen to episodes. They're hard to find on iTunes and a lot of the podcasting formats. And even on my website, there might be so many you don't know what to listen to, right? So what I'm going to do is go back and compile the best episodes regarding a particular series. And then I'll compile those into a series. And if there's any missing parts, like any holes or anything, then I'll record a new episode or two to fill those holes. So either it'll be a new person, maybe I'll do something, but that's kind of my strategy. Is it won't always be series and it certainly won't always be replays, but at least some of this, this is really to support you ladies as we move forward from here to help you to actually start taking action and to feel like you're really getting what you need to create success. Because I'm not just here talking about real estate. You know this, right? I'm here to help you build the blissful life that you dream about. And so that's really my goal. And that's why I'm creating these series. So today, I'm starting the first series. I'm really excited about it. And I wanted to say, we are going to be having some reruns, and that may irritate some of you. So if you don't like this series idea, please email me and let me know, okay? And if you love this series idea, please email me and let me know, because I'm here to serve you. I want to make sure you're taken care of, and I want to make sure that I'm providing what you want. So I've got all my great ideas, but they don't mean anything if you don't love them. So ladies, this is the time for you to really tell me what you need so that I can be of service to you. All righty. So here is the first series that we're doing. Welcome to the syndication series. So we've had many people on the show so far talking about syndication, and some of you ladies still are a little bit confused about what syndication means. So let me start with that. Syndication, super easy. What it means is someone has a big project. They need to get money for that project. So what they do is they go out there and they find investors to invest in that project. That's called a syndication. Now, if it's an actual syndication, if it's legal and all that stuff, they have to file with the SEC. There's some definite legal things that they have to do. But the basic idea is they're taking money to help invest in a project, either to buy the property, build the property, refurb the property, whatever. So that is what that very complicated sounding word is. Syndication just means people are collecting money from lots of different individuals to fund a project. So in this syndication series, we're going to be talking to several syndicators. I'm also going to be starting this series with an education piece about how to evaluate projects. This is so exciting because it's new on the market. I feel extremely excited that I met this person. It's as if the universe sent him to us. So I can't wait to share him with you. So he's going to be talking about how to actually evaluate syndication projects. We'll start this series with that, and then we'll move in so you can get to know some of the syndicators that I really want you to hear more from. So maybe they've already been on the show and we're doing a replay, or I'm re-recording something. We'll kind of see how it goes. I want to make sure, like, as we go, I want to make sure that I'm providing the best value. So here we go. Welcome to the syndication series. Today, I am so excited to welcome to the show Dr. Samuel Giordano. Dr. Sam is practicing gastroenterologist, author, real estate investor, and co-founder of PassiveAdvantage.com, a website designed to help physicians and other high-income professionals vet passive real estate syndication deals. He and his partner, Terry Kipp, have designed tools specifically geared towards passive limited partner investors to help objectify and bring to light the risk points of various real estate syndication deals before choosing to invest. The tool also has built-in functionality for tracking investment performance versus pro forma, as well as a separate tool for tracking your progress on the path to financial independence. Yay! He has been investing in passive syndication deals as a limited partner since 2017 and initially developed this tool for himself. Now he is focused on helping other physicians and investors and bringing it to the masses. His ultimate goal for himself and others is financial freedom and to be able to live a life of your choosing on your own terms. Hi there, Sam. How are you?
Hey, Moneeka. Great to see you. Thank you so much for having me.
Yeah, you too. So did I do okay with your specialty?
You did.
Perfect.
You did outstanding.
Perfect.
Yeah.
My mom's a physician. So, I have a level of integrity around this. I want to be able to say it right.
Must be in the genes. It must be in the genes a little bit.
It's so funny. Anyways, I am so excited to have you on the show. Ladies, I want to tell you a little bit about how I met Sam. I was on another show. Do you remember whose show it was? I want to mention it because it was so good.
Yeah, I want to say it may have been Taylor Lote, the passive high-income professionals or something. I want to say it was Taylor Lote's show.
So I was on that show, and then Sam called me because I offered an opportunity for people to talk like I do with you ladies and see what happens if you call me. But anyway, so Sam called, he set up an appointment, and we started chatting about syndications. And he was so funny because he's like, I really kind of want to figure out my next step. And I'm not sure what I'm doing. And he was so humble. And I got on the phone with him, and he is miles ahead of me in the syndication world. So this is such an interesting thing, ladies, that I really want you to hear is that so many people can be successful. Like I'm successful in what I do, and Sam's successful in what he does. And you've heard so many amazing people on this show that are really successful, but we're successful at what we do. And there are other people that are so much more successful at what they do. And this was one of those amazing synergistic things where he was like, well, I kind of wanted to find out about what you're doing. And I'm like, oh, I want to find out what you're doing. And then once we started talking, I realized what a value he could be for you ladies. So I asked him to be on the show. So I think this is his very first podcast ever. Is that true?
It's one of my first ones. Yes.
Yeah.
Yes.
Perfect.
So forgive me if I make any rookie mistakes. I apologize.
We love rookie mistakes. We like this true, authentic deal, so this is going to be really, really fun. And I'm really excited for him to talk to you about this tool, ladies, because so many of you are interested in sort of the passive growth opportunities of syndication. And we've had several people on the show talk about syndication, but sometimes it's hard to kind of figure it out. Where should you be investing? What projects, what people? How do you find a facilitator?
Yeah, there's a liaison. There's certain liaisons that put you in touch with syndicators and things like that.
That's right.
There's a lot of questions.
Different operators. Yeah. So how do you find get all that information? And so when Sam presented this tool, I thought, oh my gosh, this would make it so much easier, even for me. So of course I wanted to share him with you. So that is why Sam is on the show. Yay.
Thank you for having me. It's my pleasure.
Yay. So Sam, tell us a little bit about your story. Like, how did you get into this? I know you're a doctor, right? So tell me a little bit about what happened.
Sure. No, absolutely. I appreciate you giving me the opportunity, and it's great to talk with you again. So I'm born and bred in New Jersey, came from humble beginnings. My father only graduated 8th grade. My mom only graduated 10th grade. I was the first person in my family to actually go to college. And then after college, went on to work in the pharmaceutical industry research for a few years. And then after not feeling fulfilled, decided to go to medical school. And then during medical school, I actually met my wife in medical school, in between medical school and residency. She's a California girl, so somehow convinced her to stay in New Jersey, although I fight that fight every day, it seems like. But and then after I finished fellowship as a gastroenterologist, that was back in 2012, so it's been almost 10 years now. I was doing all the traditional things you think about from a personal finance standpoint. I was maxing out my retirement accounts, paying off my student loans, investing in my children's 529s, all the classic personal finance things that are preached to us. And then eventually, as loans got paid off, I was able to invest in post-tax accounts. And then there came a time where I wanted to look into more alternative investments. And that was around 2017, when around the same time was when the Tax Cuts and Jobs Act was enacted, and we lost the ability to deduct state and local income tax. And in states like New Jersey and California and high tax states, that can be a big hit on your taxes. So both sort of synergistically, at that time, I started looking into alternative investments. And then I also started looking for ways to diversify some of my taxable income. And that brought me into sort of the real estate realm a little bit.
Awesome. And then why did you choose syndications?
So basically, initially, I had dabbled in thinking about owning my own properties, owning my own rental properties, my single family rentals, looking into possibly turnkey opportunities that would, most cases out of state, since New Jersey doesn't have the best real estate investment opportunities for those type of things. And I started to hear horror stories about people who bought these turnkey properties, and that the property managers that were managing them out of state weren't always truthful. And it started to kind of scare me off a little bit. And then I talked to a few friends that had done some of these real estate syndication deals, to where they invest in the deal passively. You give in a certain amount of money and you're a fractional ownership in the deal. And then, after you do the upfront vetting and due diligence of that deal to decide whether you want to invest, once you make the commitment financially, then you start receiving distributions either monthly or quarterly, depending on the structure of that deal. You really don't have to do anything anymore. And then the great thing is you get a lot of the tax benefits, which is some of the stuff that I was looking into, where at least it doesn't increase your taxable income. And in some cases, you can use that depreciation from those deals to offset some of your other passive income or active income in somebody who's like a real estate professional type of thing. So once I saw these deals and I saw that it was more hands-off, because I still have my day job as a physician, I'm not looking to give that up. This looked like the perfect fit in terms of what I wanted to accomplish. And it was like opening Pandora's box when I learned about it. And then it just set off this whole year-long education process of learning more.
Got it. So you said some things there that I really want to highlight for my ladies real quick. So first of all, you talked a little bit about turnkey. We are probably going to be doing a series on turnkey also because it's a strategy that I really, really love. But what is interesting is you talking about all these horror stories of the scam artists out there that create really dodgy product, right? The properties aren't right. The management company that they put in isn't right. There's a lot out there that doesn't work, right? But there is also a lot out there that does work. And I think one of the value that I provide in this podcast is vetting these people, getting to know these different people and the operators. My ladies go and invest with them and I hear feedback. So we're able to together put together sort of a network of operators in the turnkey area that my ladies can invest in. But the syndication area is not that much different. So it's so interesting that you said, kind of like they were opposites, because in the syndication area, also there's a lot of scam artist operators, right? There are people that are taking people's money. Oops, we lost money. And, in anything in real estate, if the market goes down, you lose money. I mean, it's an investment, right? So not to scare you ladies off, it's significantly more secure than other investments, right? But it is an investment. And so if that goes down, there's a lot of operators, even in the syndication world, that are kind of scamming people, unfortunately. And so
I wish that wasn't the case, but you're right.
Right? Isn't that true? So I think the big difference with the syndicators, and you tell me if this is correct, is that they have to file with the SEC. So these guys, they're being tracked by the government. There are ways to find out about their reputation. If they start to scam people, they'll be shut down. So there's a little bit more security as far as finding operators this way, but it still doesn't mean that they're perfect. If they say that you have an ROR, and we'll talk a little bit about this, ladies, but if they say you have an ROR of 34%, and then they give you 9%, well, at least you didn't lose money. Do you know what I mean?
Yeah. Absolutely.
So it's very important to find syndicators that have a really, really good reputation, which is why I'm doing this series, because I personally have invested with several people. Interestingly, Sam has invested with some of the same people, which I really love.
That's right. Yeah.
And I've developed relationships with some of these other syndicators. So that's why we're doing this series. Is first, we want to educate you on how to evaluate projects so that as we go through the next 6 weeks talking about syndication, you can look at each one of those operators. If you like what you hear, you like what kinds of projects they're in, you can get information from them. And then when they start sending you projects or opportunities, then you can go through those opportunities with this tool that Sam's going to be talking about today. So there is kind of meaning to my madness. There's a reason I'm doing it this way, right?
I think it's perfectly reasonable. Absolutely.
Yeah. So I just wanted to point out, ladies, that it is true that out there in every industry, whether it's education and real estate, whether it's turnkey, whether it's REITs, whether it's syndication or whatever it is, there's risk. Yeah. So the operator is going to be the key, wouldn't you say?
I do. And unfortunately, unless you have a close personal relationship and somebody could make, introductions, like how, the service that you provide to your listeners is huge, because then you have sort of a go-between where if somebody's not performing adequately, then you can obviously not recommend them any longer. So that's a cost to them. So they then would have to treat your listeners and the people that you referred to them well. But as far as if you don't have those associations available to you, in my opinion, the only way that you can combat that sort of uncertainty, or that sort of, to kind of differentiate which syndicators are good and which are not, is through your own education. And so the first year that I started to learn about these syndications in like 2016, 17, because of the fact that some of these syndications require a pretty significant upfront financial commitment, I made a promise to myself to spend an entire year just to educate myself. And that was in the form of podcasts like your own, and form of reading as many books as I could get my hands on, looking at different real estate forums, And anywhere I could get the information in regards to the real estate syndications, I was taking that all in. And as I was going through that year-long time frame, I used like sort of like initially like a note sheet to take notes on sort of some key points, or if I heard something really interesting on a podcast, I'd put it on that note sheet. And then eventually that note sheet sort of morphed into like an Excel sheet where it actually had parameters that I was kind of looking for in these syndicators. So that when I did get presented with a deal, and then, basically that first year, in addition to the education, I would try to make, if I heard a syndicator, or there was a recommendation of a syndicator through a friend, I would reach out to them, try to have a discussion, see if it was a fit. And then what you tend to do if it's a fit is to get on their investor list. And that at that point is when you start receiving these deals and through what they call like an investment summary or a pitch deck. So when you first see those, it's kind of overwhelming. I mean, some of them are like 40 or 50 pages and you don't really know what you're looking at. But over time, when you combine some of the education components into what metrics you need to look at, and then after looking at some of those investment summaries multiple times, you start to pretty quickly pick out like what the metrics are that you're looking for, what's in the investment summary. And then over that year, I sort of formed this sheet, and it's what I still use today. And then, it's gone through many iterations, but it gives me the confidence that there's not one clear risk point or red flag in the deal, or if there is, then I'm then aware of it, and I can then decide if I want to invest in that deal or I want to move on and invest in another deal. So getting back to the question, the one way to combat that uncertainty and not knowing whether someone you're dealing with is scrupulous or truthful is to kind of educate yourself as best as you can. And the whole process of forming this sheet is to try to truncate or shorten that education process that I had to do, so that people can more quickly be pointed out to certain areas that they need to look at.
Got it. So that's kind of the education process that you went through. What is it that you actually go through when you are evaluating a syndication, like an opportunity?
Sure.
So, and I do know, so ladies, just so you know, we're going to do a high level here. We're going to do a really awesome deep dive and extra. So yeah, just give us kind of a high level, and then we can go much deeper. We'll have more time and extra to do that.
Sure. Sounds good. So I would say when you look at a deal, the main components that you're looking at is the three main components would be the sponsor, the market, and the deal, and in that order. Meaning that the sponsor is clearly the most important component of the evaluation. But that's the trickiest, because there's a few objective things that we look at, but it's not as many like clear quantitative objective parameters that you can look at when you're evaluating the sponsor. And a big thing is like when you do have that phone conversation with them, like what's the feel you get? Do you feel like they seem like nice people, like you'd want to go have a beer with or hang out with? Or do you feel like as soon as you get off the phone, you're like, I don't want to talk to that person again? Like you got to trust your gut. And that, even though that's not quantitative, like that's one of the more important things that you can have when you're evaluating these sponsors. So the sponsor is the one component. The market looks at parameters where people are moving. So in general, people are generally moving. So like the Sun Belt area, the Southeast, Florida, Atlanta, Texas, Arizona, and moving out of states like our states, like New Jersey and California, New York, and moving to places there. The weather's good, the taxes are better. So most of the investments I look at have some sort of what they call population migration into those areas. You look at job growth, you look at the education in those areas, you look at the average salary in the particular community that the apartment is going into. And then the third part is the deal itself. And you can get really granular in the deal metrics because those get sort of quantitative. But the three main breakdowns of the deal itself would be the property metrics, the debt structure, which is extremely important. What kind of debt is on the deal? That's one of the higher risk points of the deal. And then sort of the rent growth projections and things like that. So that's kind of like a high level overview of the main things that you look at in a deal. But I think early on, you need to kind of think about like what your end, as a limited partner investor, in my opinion, one of the best things you can do is think about what your end game is, like what you're doing this for, and where you see yourself in whatever time horizon you set out, if it's 5 years, 10 years, 15 years. So I kind of did that early on, and that really has made all the difference, because then I kind of can see where the goalpost is and then see how close I am to getting it. But if you don't know where that goalpost is, it makes it a little harder to see like what you need to do to get there, you know?
Absolutely. And that was one of the things that the very first things that we talked about, you and I, in our first conversation, right? This is one of those things that I bring up for everybody, is that you need to know where you're headed, right? There are a few things that we need to know: is where am I headed? Why? And what are my resources, right?
No doubt.
And that sounds easy. It's so much deeper than that. But once you know those things, picking a strategy, whether it's syndication or anything else, becomes easier. And then setting the goals of that strategy and the path of that strategy is so much easier. So you want to pick a strategy that is really aligned with who you are, all of it, right? And like I was talking to somebody today about what are your resources, and his wife wasn't on board. Well, but she's one of his resources. If she's not on board, that's going to be a really hard journey for you, right?
It's a big deal.
Right.
Absolutely.
So your relationships are part of your resources. So personal as well as network. So sorry, I go off on these tangents, but I just love what you were talking about.
My wife wasn't on board initially either. And it took her a little bit of time, but over time, she definitely, I started to show her the numbers. She started to learn a bit more, and now she's more involved. So sometimes it takes a little transition, you know?
Yeah. I'd love to talk a little bit. Maybe we can talk about that in extra too, about how you helped her to make that transition, because I'm getting a lot of those questions lately. So, but anyway, so yes, this goal, having a goalpost and knowing where you're going is going to make a huge difference for you. And the goal, that is your first goalpost. Once you get to that goalpost, there will be another, right? So don't worry that, I'm limiting or blah, 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 whatever it is. That goalpost will eventually change once you reach it too, right? So
that's true, no doubt.
Yeah.
And the biggest thing with these kind of investments, and when it's like something new like this, and there's some complicated variable to it where it's not super intuitive to understand, is I find the hardest part is taking that first step.
Yes.
And at least for me, and I'm sure it is for others. So that I needed that education. Like sometimes I feel as if education conquers the fear. So whether it's in this or in other things, like when you feel like you're fully prepared and you've done all you can, then it brings you closer to taking that first step. And I think knowing the things to look for, having a tool like we have discussed and stuff like that kind of helps take the first step. And that's really, and once that happens, then it becomes easier after, next thing you know, I'm 3 years later, I've done over 10 syndication deals, and I can still remember my first deal a couple of years ago. So it's amazing how quickly it can happen, you know?
Yeah. So I also believe that education really helps to mitigate fear, but there is such a thing as like analysis paralysis, right? Like don't overeducate. There is a point where you have to actually take that step, right? So talk to us a little bit about how you took those first steps to invest in your first deal.
Yeah. So basically the first deal, so the criteria that believe it or not, the criteria I look for now is different than the criteria that I used on that first deal. And that's the nature of sort of the economy and different, as your education evolves and things like that. So that first deal, I was primarily focused, I would say 80% on the sponsor, because even though I had done all the research and my analysis on what to look for in deals, I really wasn't sure that I wasn't missing anything. And that's that same thing, paralysis by analysis. Like I was at the point where I'm like, do I know enough? Do I not know enough? And the way for me to mitigate that is to put even more of a weight on that sponsor. So the sponsor I invested in that first deal, when my interactions with them and their organization and everything, I'm like, these guys are first class. They seem like they're doing things the right way. I really have confidence in what they're doing. I'm like, you know what? I'm going to take a leap and go with them. And I did. And thankfully it's worked out. Now, they had what's called a fund structure where it involves sort of multiple investments in one vehicle. I look for more of the single asset deals as opposed to the fund deals, just because some of the times with the fund deals, it's a little harder there's nuances between the funds and the single asset deals, but the single asset deals allows me, now that I'm more comfortable with the vetting, to actually vet more of the deal. Whereas when it's a fund, they may not have even bought the properties before you've invested. So you really are 100% looking at the sponsor, where at that point I was comfortable with. Whereas now, since I'm more comfortable in what I'm looking at, I'm more interested in the single syndication deals. But that's really what allowed me to take that first leap, is that I had the most confidence in the sponsor, and that's where I was comfortable with at that point.
Very, very cool. So what is it that's changed now? Like, what is it? You said that you don't look at the same things now. Back then it was all about the sponsor, right? So now, what do you tell me a little bit more about now.
So the sponsor is still, I would say, the most important. But now, because of the fact when I like to, at the stage I'm at now, like my sort of overall goal was to try within 10 to 12 years to get to a point where I could create enough income to sort of cover my expenses. And so I kind of had an idea of how much I would have to invest in these real estate syndication deals, looking at average or conservative returns to where I would get there in 10 to 12 years. So in order to do that, a portion of me is focused on what's called like the velocity of money. So I'm looking for deals that may not have like a 10-year hold time to where it's taken time to get my money back. I'm looking for deals where they may have a 5-year hold time, and hold time is just the amount of time that the deal's projected before they sell the property and do any business plan or value add or whatever it is to sell it. I'm looking for deals that may say that it's a 5-year hold, but in reality, they're really looking to fix it up and sell it in 3, or refinance it in 3, and then you get all your money back during those refinance, and then I can deploy it in other deals. So now, back then I was more focused on security, whereas now I'm more focused on trying to not take extra risk, but just do deals where there's more of a chance to get in and get out in a quicker time period, so I can redeploy it, because then you could capitalize those gains quicker, and then that 10 or 12-year horizon, I could potentially achieve that in 7 to 8 years if things work out right. So one of the things is that the deals I look for have a shorter hold time. I'm less interested in the fund structure at this point. Now, 12 years from now, I may then switch back and want the security and not want to have to continue to redeploy deals. And then the markets I've looked at has changed a little bit in that period of time, as well as the economics change, rent control states and different things like that affect sort of what you can do in terms of increasing the rents after you do some renovations to some of these investments. So all those things have changed, believe it or not, in the short 3 years since I started investing. It's like a constant thing you have to kind of keep up with a little bit.
Yeah. So, most of my ladies know what a syndication is. And ladies, I've mentioned this a couple of times, but a syndication is basically what we're talking about is an operator who has a big project, is looking for money. He's registered with the SEC, and you have an opportunity to invest in that project. That's like the real simple way of saying it, right? However, Sam just mentioned a bunch of little things that we normally I don't think we've actually mentioned in this show. So I'd like to kind of break it down just a little bit, Sam. So ladies, what happens is you once you find an operator, you'll get a project, and then you evaluate that project, right? And then you have an opportunity to either be a preferred investor. Sometimes they have 2 different levels of investors, and sometimes they don't, but they've got preferred and standard or something like that. And the preferred is usually the people that get in first, and they get a higher rate of return that's paid to them. Then they're basically borrowing money from you to start this project, right? So you might get 10% if you're preferred, and 8% if you're not preferred. So and those are just examples, right? So now what happens is the syndicator takes all that money, they buy either they buy the property and start the refurb, or they already have the property. It's just being used for refurb, whatever. They'll tell you what it's for. And now they'll do a forced value add. A forced value add is basically they're fixing it up, right? They're doing a remodel.
Yeah.
And so
right.
and their goal is to be able to raise rents, because when you get a loan on a property like this, on a multi-unit, I think many of you ladies know this, your loan is based on the income of the property. So it's not based on your personal finances. It's based on the income of the property. So the property is getting a certain amount of income. Now they refurb it with your money, right? And then they raise rents. They'll like clear everybody out and put in a bunch of new people. Most of the time they'll do it piecemeal. Like as people leave, they'll put in people at higher rents. As leases come due, they'll raise the rents like that, right? So over a period of time, they're going to raise rents. And then there's a couple of things that they can do. They can sell the property and do it again, right? Or now they've got cash flow, they want to keep it. So often what they'll do is they'll refinance it, right? They'll take some cash out, and that cash out is now paid to all of the investors. Right. So
that's exactly right.
Right. And this is tax-free income because it's out of a refinance. So you get this income. Then a few years down the line, like Sam was saying, 5 years, 10 years, whatever, 12 years, they might sell the property. And so at that point, you get a portion of the equity in that sale. And before that, you're getting a portion of the rent every single month.
That's exactly right.
And there's a lot of, not every syndicator will pay on every one of those pieces. Not every syndicator has the same plan or way that they run a project or pay their people. But in general, those are the different opportunities. And there are a few more opportunities, but that's kind of a base level, right, of what you can get. And so then you'll hear things like ROR. So people will say, oh, I got a rate of return of 34%. Whoa, well, what does that mean? Over 5 years, what happened was they got 10% every year. During the refinance, they got another percentage. Then they got all this rent, right? And then at the end, they got another percentage, right? Some of it's taxable and some of it's not, right? So that's when you hear the ROR. They're taking all of those ways of being paid and they're adding that into over 5 years. This is what it averaged out to. So that's when you hear that term, that's what you're looking at. Did I miss anything, Sam?
No, I think that's great. Yeah, it explains it perfectly. I think with these multifamily that are more than 4 units, the value, instead of it being like a single family home where the values are based on comps, where if somebody wants the house down the street sold for X amount, so my house is worth X amount. The multifamily, when it's 4 units or more, are based on that net operating income, like you said. So if it's a 200 unit property, and you increase the rent in each of those units $100 a month, then that all of a sudden kicks up the value of that property a significant amount. And then the difference there between what they paid and what it's now worth based on the operating income, they could get some of that cash back and sell it and get some. So there's the nice thing about multifamily units is that there's clear numbers based on what you can collect and what the value is. It's not like I'll pay you X amount, $600,000 for your house. There's clear numbers are based on so when they can increase those rents, then it's clear data as to what the value of that property is. And then they can, use the benefit. It can benefit the investors and the syndicators just from that small, even though it doesn't seem like a lot, increasing $100 a month rent. But when you add in all the months and you add in all the units, it becomes a pretty significant amount of money. So no, I think you explained it perfectly.
Great. And thank you for that additional input. You're not doing this on smaller properties. You're doing this on larger. So the couple that I've done a few syndications. I've done one in a 252 unit property. I did one in a 550 unit property. I did one in a storage development ground up. I did another one in a mobile home park that was being refurbed. So, that's how I've invested in a lot of different areas that I know nothing about, but I want to get in on the action, right? Or on the opportunities there. It's a way for me to go to an expert, right? Like we're talking to a doctor, right? You wouldn't do what he does at home. You're going to go to him, right? And that's how you do.
I only play one on TV.
Or on real estate investing for women. But yeah, so this is like, I really believe in going to the pros. If someone's doing this and doing it well, I want to invest with that person. And a lot of these things, I want the advantages that those markets give us without having to learn about them myself. I'm so busy myself. I don't have the bandwidth to learn all that stuff, right? So it's given me an opportunity to invest in places that I can't learn enough about, but I can learn about the operator, right? So, and I don't want to be responsible for myself for a multi-million-dollar project, right? And something that I don't know. So it's better to have a team. So,
and that's one of the examples that you used in relation to the unit size. Like that's one of the criteria we have in the sheet where we look for properties that are at least 100 units or more. And there's a couple reasons for that. One is that you can have economies of scale. So that's generally the number that you can afford to hire an on-site property manager, as opposed to if you have like a 40 unit or 50 unit or something like that. In addition, at the time of sale, if you want to sell to an institutional buyer or private equity, they generally don't want to look at complexes or apartment complexes that are less than 100 units. So it just gives you more opportunity. So that's a good example. And that one of the criteria we look at in the sheet in terms of the deal specific criteria, is it 100 units or more? Is it 150 or more? And then it assigns scores based on that. So that's good that you said that, because that does affect the growth opportunity and the risk profile of the deal. So that's a good example.
Yeah, I love that. Thank you. So talk to us about the kind of people that should be investing in syndications. Who is this for?
Yeah, so it's, it depends at what level you want to get into it. So if you're looking, there are like crowdfunding websites like CrowdStreet and Real Crowd and Yield Street and things like that. So a lot of what they do is they aggregate syndicators that may be earlier syndicators or have a hard time getting investors, and they then have deal minimums that are smaller. So if you go to those main sites, you can see some of the deals that have smaller minimum investments, but it's not always the case. But sometimes the deals, like I said, they're newest syndicators, so there may be a slightly higher risk profile to some of those deals versus what they call private placements. And the private placement deals, and there are two criteria. One looks at specifically at accredited investors, where you have to meet like a certain financial criteria in terms of your net worth and your income. And then there are some that don't require you to be an accredited investor. And some of those deals, the minimums could be as much as 10,000, 20,000, in some cases even 50,000. So the way I look at it is kind of like people who have some disposable income and they want to get into real estate, but they don't necessarily want to earn things on their own. I think that's one category of people. The second category of people are that who start with active investing or active rentals. They may start with a few single family, then they have maybe a quadplex or an 8 unit, but they want to get out of the active involvement. So there are some syndications that actually take what's called a 1031, where they could take that eight portfolio of 8 units investment and then transfer it into these limited partner syndication deals. So you see people either that haven't invested a while or a little more mature in their career or have a little more disposable income that get right in and kind of go around that active stage. And then there are some who start in the active stage that eventually work up to having more units and having more disposable income and cash flow from those units, and then get in syndications that way. Primarily because one of the barriers of entry in these private placements is that some of the investment minimum sometimes can be a little higher. But once you meet that criteria, I think syndications are good for everybody. And I think everyone should have a component of real estate in their portfolio. And then you can do it through like REIT investing and equities investing. But oftentimes if you've seen the market back in March of 2020, when the market goes down, the REITs go down. So there's not a lot of diversity in that case. But in times like now, where the market's very high and inflation is a concern, and you really want to hold on to hard assets, I think real estate is a great investment right now. And that's why we're seeing things become more and more competitive. So it's sort of a long-winded way to say, I think it's right for most people at syndication investing, but it's just a matter of sort of where you're coming from and which angle you want to take.
So let me get a little bit of clarity on this. So
Sure.
My understanding is that for most of the syndications that I've looked at, the minimum I've ever seen is 25,000, but usually each unit is about 100,000. Did you say that you can get in for less? Talk to me a little bit more about that.
So in the sort of crowdfunding platforms, like the CrowdStreet and those kind of platforms that have similar investments to syndications, some of those minimums may be as little as 1,000, 2,000, 3,000, anywhere in that lower range. But you just don't have as much control over the vetting process of the syndicator, because that's done by sort of that particular website. And in addition, in some cases, not always, but in some cases, it's newer syndicators. So a lot of the more mature syndicators don't always go through those websites if they can raise the capital on their own. Whereas if a newer syndicator doesn't have a track record and is really looking for some help from from aggregating some of these investors on these websites, then the cost to that is, one, the websites may take a fee, but they also decrease the investment minimum. So those are the examples where you would be able to get in at a lower minimum. But in the private placements, like some of the stuff that we're talking about, you're right. Most of those are in the 25, 10, 50. Believe it or not, if you ask syndicators, even if the minimum is 50, especially if it's your first investment, and you say, you know what, I really like what you have to offer, I'm really comfortable with you, but with my first investment, can I maybe go half of that? And then after that, we'll go to the minimum. So if the minimum's 50 and you offer 25, most syndicators, especially if it's your first investment, won't say no to you. If you just have to ask. I mean, sometimes it can be a little weird to ask, but it's a lot of money. So you really want to be comfortable with that. And I think they realize that too. And then if it works out, then going forward, you can then stick to the minimums. But so there is a little bit of negotiation within reason that you can negotiate that minimum down a little bit to make yourself more comfortable.
Got it. So we are running out of time, Sam, but I want you to talk a little bit about how to use syndications to achieve financial freedom. So kind of high level on that.
Sure. So the way I sort of looked at it is there, you often see like two different sort of mindsets, in that some people are either entirely based on investing in the stock market and going that route, especially if obviously you're not aware of syndication investing. And some people that have been their eyes open to real estate are completely taking all their money out of their 401k and outside the stock market. So you find people that are strongly on either side. I find myself kind of right in the middle, in that I still do my traditional pre-tax retirement accounts. I am an employee as a physician, so I max out those. And if you take syndication out of it and you think about sort of the classic personal finance education, people use like a 4% rule, in that the first thing you do is you calculate your annual expenses, say, for example, $100,000 a year. And if you want to have an idea how much of a nest egg you need to save in order to retire, you would then times that by 25, which gives you 4% withdrawal rate of your money. So in the case of 100,000, if you say your annual expenses are 100,000, then you would have to save 2.5 million in order to cover that 100,000. So that may take a decent amount of time. And that's based on the 4% withdrawal rate. When you add in syndication investing, where a lot of these investments are somewhere in the 8 to 10% cash on cash, if you're doubling, or in some cases even tripling the return, then that may be 20-year time horizon if you just invested in the stock market. can be truncated down to somewhere in the 8 to 10 year range if assuming typical investment returns using syndications. So the way I looked at it is I wanted to invest somewhere in the $50 to $100,000 a year into syndications. And over a 10-year period of time, that would allow me to have somewhere in that, taking all the returns from those deals and then reinvesting it back into new deals. That would give me somewhere in that $1.2 to $1.5 million range. And if you then take 10% annually from using that cash flow as a rough estimate, even 8%, that can cover if my expenses were $120,000 a year. That's kind of what I wanted to cover. And that's how I sort of came with that number. But the beauty is that would cover my entire expenses without taking into consideration any of my stock market investing. Now, I realize that seems like a lot of money and not everyone can do that, but that's sort of, further along in my career, I wanted to invest and have, that's sort of what I allowed myself to allocate to that and what I wanted to achieve in the period of time that I had. So that's sort of the way that I looked at it is I wanted to invest a set amount, assuming a specific return, and to cover my expenses within a 10-year period.
Got it. Okay. That was a lot of numbers. So ladies, feel free to go back and listen and write it down when you're not in your car or whatever. Right? Sit down with a piece of paper. But that was a really, really good breakdown on sort of how he set his goals and then how he decided to achieve them and setting his time frame on when he wanted to achieve that, right? So he set his goalpost and then set a path to get there. So it's a really, really good example of that. So some of what Sam is doing now is really helping other people to achieve goals in a very similar way. And so he's created this spreadsheet, which is obviously why I'm having him on the show. It's more than a spreadsheet, this tool that helps people to evaluate syndications. And so could you tell us a little bit about the spreadsheet specifically?
Yeah, so basically it started as sort of what I created for myself back in that 2017 time frame. And then as I was going through creating the spreadsheet, I started to speak with other real estate investors, other people in the space that are doing similar limited partner investing like myself. And they're like, oh, can I get a copy of that? Can I, I would pay you for it. And at the time, I'm really just I'm using it for myself and I don't necessarily feel comfortable giving it to somebody else. But I started to see that it allowed other people, and I shared it with many friends in the beginning, to take that first step. And I'm like, you know what, this can break that barrier to entry, can break that fear hurdle that people have to kind of get them to take that first step. And so we created a spreadsheet. There's 3 components to it. One looks at the deal itself, to where you're analyzing the deal, going through more specifics in relation to the market, the sponsor, the market, and the deal. The other components are a deal tracker, which looks at when you have made the investments, it allows you to track the investments based on what your distributions that you're getting from it versus what they said they were going to pay you, and gives you a side-by-side comparison for all the investments you have. And then the third component is tracking your path to financial independence. So some of the numbers we just talked about, you could plug in your own numbers. If your annual amount you can do is not 100,000, but 50,000, then it shows you how long it would take you to reach your desired expenses that people can plug in there. So we tried to make it like a one-stop shop for people who are interested in passive investing for most of the tools you would need to both vet the deal, monitor your progress, both on the path to financial independence and then the deal performance. So that people would, take that step, because I think for some people it can change your life. Having the liberating ability to kind of cover a lot of your expenses with your investments. You may choose to continue to work every day just like you do. I love my job. I'm not looking to quit, but there's a liberating feeling when you have the ability to cover some of your expenses and not have to worry about what's going on in your job life.
Right. I think, and that's what someone asked me today again, like, Moneeka, why are you looking at retiring in 2 years? Are you unhappy, or is David unhappy? And no, we're not. We're not. But our priorities are changing. Our parents are more elderly. There are things that we want to be able to do. And it's nice to be able to say, you know what, I don't have to worry about money so much that I have to be so committed to any particular job. Like I was saying, if Dave and I wanted to take 6 months around the world and again, we've done it once before, and his company said, well, you can't do that. Well, he can say that's okay. Right.
Yeah.
And do it. And he comes back and he finds another position. Right. But he's not freaked out about how are we going to pay the bills. Right.
Exactly.
So it gives you're living in choice rather than in need. Right. And so it's just a different way to live life. Right.
It changes your whole mentality. I mean, I'm not quite at the point yet, but even just getting the passive income that I get in now, then I'm like, well, I only really need to bring in X amount for my job, if I did want to change things. And it goes from I want to work from where it was I have to work.
Right.
And it's just you feel more control. And at least in this COVID environment where people are getting more stress at jobs and physician burnout and all sorts of things, so many more people are looking into these things because of that reason. They want the flexibility if there is environment changes, if there is job changes, that they still can feel like they can cover the bills, and it's not as if you're worried about that. It's just, and that's part of the reason we did this, is to try to get more people to that place, because I think it's a different place to be versus the typical.
Right. And I think the other thing is that it's not that you have to get there to feel that liberation and the comfort. When I started investing in real estate, I was making, well, I won't tell you what I was making very, very little. So, I was putting away $100 a month type of thing. But the thing is that once you start taking that action, you suddenly feel like, oh, I'm going to be able to take care of myself. There's something that happens when you realize that you're on a path to a better life, right? And that you're going to be able to take care of yourself, and that you've figured this piece out. You can figure stuff out, right? So you don't have to be at the goal to feel that feeling of liberation. It's getting on that path that really opens you up.
You're absolutely right.
Right? Yeah.
Yeah, no doubt about it. Yeah, I mean, even just there's something about seeing the checks come in the account that I use for syndications, and I'm not doing anything. Like, even as a physician, if I stop choosing to go to work, I'm not going to get paid. So my income as a physician, or as anyone who does, labor that requires themselves, it requires me to go to work to do that. I don't make money while I sleep as a physician. Whereas with this kind of investment, it doesn't it's unlimited in terms of, it doesn't have any limit to my time. Like, I only have the same amount of hours in a week that you have and everyone else has. Whereas with this kind of investment, the limit is basically for your financial means to do it. And then, but from there, it just makes money without you having to do anything, which is a different place to be. It's the classic passive income as opposed to the active income of your day job.
Right. I love that. So tell my ladies, so here's the really cool news. So he is offering right now, he's offering this to the public for the very first time. If you're listening to this show for the first time right now, you get this price that he's going to quote. Just understand that price will go up. So if you're listening to this a year from now or 5 years from now, the pricing is going to be a little bit different. But they did want to share how much it is for this tool, Sam.
Yeah. So what we have offered is, I wrote a free ebook that goes over sort of in more detail in a book format, an 80-page ebook on how to passively vet syndication deals. So that's certainly free, and there's no price, and you can just download that at passiveadvantage.com. There you can also find the tool that we're talking about that goes through all of the different metrics to look at, to track your deal, to track the deals you have invested in, as well as your path to financial independence tracker. You can purchase the tool. The price of the tool right now is $199, but we're giving all the listeners a 10% coupon discount. So at purchase, you put in the words BLISS10, BLISS 10, and that will give you 10% off the $199. And it's the least we can do. Hopefully you guys find value of it. And I think it'll help with your education. It'll help to see what's important when looking at these deals, as well as see where you are on the path to financial independence.
I love that. And ladies, I do have a special web URL for you to go get the product or the tool and then put in the coupon code. And that URL is blissfulinvestor.com/syndication WS. So the WS is for worksheet. So syndication WS, blissfulinvestor.com/syndication WS. And then when you go in there and you select the product, then you can put in the Bliss 10, BLISS, and then the number 10, 10. And then that's how you get your 10% discount. This pricing is already like incredible, but it's nice to get an extra discount. So go check that out. And then the other thing,
my pleasure.
Yeah. And then the other thing that I'm super excited about is Sam has agreed to do a webinar for us where he actually goes through the worksheet. So for those of you that want it right now, you know how to get it right now, right? To me, it seems like a little bit of a no-brainer. If you're you're interested in syndication, this is a no-brainer price. So go do it. I don't want you to stall, right? But if you want to know more, like you're more interested now in syndication, you want to kind of know what the numbers look like and that sort of thing, Sam and I are going to be doing a webinar together. So, and he's going to do a breakdown of a deal. And that is going to be on Thursday, November 18th, 2021, of course, at 5 p.m. Pacific time. So it's 5 p.m. Pacific time, 8 p.m. Eastern time, and then everything in between. So that is going to be on November 18th. And if you want to sign up for that, go to blissfulinvestor.com/Sam webinar. So Sam, SAM, webinar, you know how to spell that. So blissfulinvestor.com/Sam webinar. And definitely come, you get to ask questions. He's going to go through a presentation. And of course, he'll answer as many questions as we got time for. So please put that on your calendars and you'll get some reminders too. Okay, so Sam, do you have anything else that you wanted to share with us before we sign off?
I think we covered a lot today. I truly appreciate you taking the time, Moneeka. It's been a pleasure talking to you. It always is. I feel like we have a lot of synergy in terms of what we look for and what we're looking for in terms of what we use real estate for. And I want to bring it to more people to kind of get to where we are, to make their first investment. And I'm hoping that this tool allows people to do that. And I'm happy to answer any additional questions that they may have, and happy to answer more questions at the webinar as well.
Yay. Thank you so much. This has been such a good show. Thank you for all you've offered in this portion of the show.
It's my pleasure. Anytime.
Yeah. And ladies, stay tuned. We've got more in extra. We're going to be talking about sort of going through a whole deal. We're going to do sort of a run through on a deal. I'm going to talk to Sam. He didn't know I was going to do this, but I'm going to talk to him a little bit about that transition that happened for his wife and how they kind of made that happen, because I know this is a big topic for you ladies. And I am going to also ask him about the 1031 DST. He kind of threw that in just a tiny little bit, and it's a topic I'm really interested in. So I'm going to ask him about that in extra. So if you are interested in those topics, stay tuned. If you are interested but are not subscribed yet, just go to realestateinvestingforwomenextra.com. You get the first 7 days for free. So you can get this one for free and as much as you can listen to in the first 7 days. And then you can stay subscribed if you would like. So that's realestateinvestingforwomenextra.com. For those of you that are leaving Sam and I now, thank you so much for joining us. Have a great day and I'll see you soon. Take care. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.